For most of American history, the American dream felt possible. You worked, saved, and invested. And if you gave it enough time, the economy did the heavy lifting for you. But for a growing number of young people today, it doesn't feel like a real option anymore. To understand how we got here, you have to go back to what life looked like in the decades following World War II. After World War II, the US economy was built on stability, not speed. The federal government backed long-term fixed-rate mortgages, which meant that families could lock in the same monthly rate for decades to come. At the same time, wages tended to rise alongside productivity. More households lived on a single income, and everyday expenses like rent or insurance took up a smaller share of what people earn. In the mid-1980s, the typical price for a home was just over 3 times the median household income. Today, that ratio is closer to 5 times the income nationally. And in many cities, it's significantly higher. That means that a down payment that once took years to save up can now take a decade or more. And at the same time, in many places, rent has risen faster than wages, making it harder to save. While that was happening, financial markets were evolving too, as trading became easier to access than ever before. What once required calling a broker and waiting has now moved onto your phone, and trading costs have fell close to zero. Buying or selling started to be something that you can do at any time, anywhere. You could see this impact directly in how long assets are being held. In the 1980s, a typical stock stayed in somebody's account for 5 years. Today, the average holding period is closer to 5.5 months. When trading becomes this fast, cheap, and easy, holding periods naturally shrink. This didn't just change what people invested in, it changed what strategies work. As demand for faster outcomes grew, platforms and financial products evolve to meet it. And this is where leverage enters the picture. Leverage is borrowing money to increase the size of a trade, allowing a relatively small amount of money to control a much larger position. For most of market's history, access to leverage was limited and professional. But today, that barrier is gone. The market made accessing these tools incredibly easy. Leverage stopped being something specialized and started living alongside everyday financial products, built directly into the same platforms that people use to invest, save, or spend. When leverage is placed right next to long-term investing, the temptation is on purpose. For most of history, investing and money weren't things we talked about. You judged progress by whether your own life was improving. But social media flipped that dynamic. Now the most visible outcomes are the most extreme. You don't see years of hard work or slow improvements. You see a single moment where everything looks perfect. It becomes easy to feel like you're falling behind, and social media rewards that shift. Algorithms don't reward patience, they reward extremes. And once people chase extremes, platforms evolve to exploit that mindset. And that's exactly where online casinos and prediction markets slid in. With massive social media presence, live odds, and instant results. It's the same dopamine loop as leverage, but stripped down for pure speed. And that's what I'll be diving into next in part 2. Thank you so much for watching. If you liked the video, make sure to subscribe. Peace.